Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. I'm thrilled to have with us Eva Shang, who is the general partner and CEO of Legalist. Legalist is a fascinating institutional asset management firm with strategies like litigation finance, bankruptcy, and government receivables, and they're tech-enabled and modern, and we'll certainly talk about that. Eva also has a really interesting story as to how she got into this business, so I'm excited to chat with her about it. With that, welcome to the podcast.
Thank you so much for having me, Lex.
My pleasure. Can you talk a little bit about Legalist today? What is it? How much do you manage in assets, and what kind of strategies do you have?
So today, Legalist manages around $900 million in assets. Our LPs include hospitals, university endowments, foundations, family offices, and we manage them in three particular asset classes: litigation finance, bankruptcy, and government receivables.
What does that mean, those three strategies?
So litigation finance, which is our core strategy, we have around $500 million of assets in this asset class. The core of it is that we make an investment into a litigation asset. So if the litigation is successful, then we get to recoup our investment plus a significant upside from the proceeds. And if the litigation is unsuccessful, then it's known as non-recourse, which means that we actually don't get paid back. So you can think of it as like a venture investment into a litigation, except that you're not investing in a company, you're investing in whether a case is successful or not.
Just to touch it lightly, what does it mean that you're using data analysis and technology in this particular strategy?
So the backstory of how my co-founder and I got into the litigation finance space is a little bit unusual. So most litigation funders are run by two lawyers who used to work at a law firm. They raised some money and they decided to venture into litigation funding and funding a few large cases that they underwrite themselves. So the way that Legalist got into litigation funding is the complete opposite of that. So we actually dropped out of Harvard to start this company. Christian and I, my co-founder, were in the Y Combinator program in the summer of 2016. And we were actually working on a totally different idea that used the same technology. So we were working on a legal analytics product where we were scraping state and federal court records, assembling that information, packaging it up into analytics, and then attempting to sell it to attorneys. We actually didn't get very far. The first day that we got there, John Levy, who's the general counsel at Y Combinator, stopped us and was like, "I heard that you're working on a legal tech company." And we were like, "Oh, yeah." And he was like, "I really don't like your idea." And we were like, "Oh, we just got here." Then we were like, "What don't you like about our idea?" And what he essentially said is that legal analytics is such a tough sell because lawyers are not actually incentivized to be more efficient. Lawyers are not incentivized really to do their job better unless it's like they're in-house or some other scenario like that. And so we were like, well, what are lawyers incentivized to do? And he said, semi-ironically, lawyers are incentivized to get paid. So from there, that really got us thinking about this idea of litigation finance, which he brought to us a little bit later. And this idea that it helps lawyers to get paid, which is one of the biggest needs in the justice system, right? If you have a personal injury case, you can always have your lawyer take it on contingency. But if you have a real commercial dispute that can span multiple years, lawyers aren't going to take that on contingency. And so that's really where the need for litigation funding comes in. And so what we decided to do with our technology that we had built instead, which gave us a bird's eye view over every state and federal court docket in the country on a live basis, is we decided to pick out cases that we thought were going well and that matched a general litigation finance mandate and then reach out to them and say, hey, congratulations on having your case go so well. Would you be interested in using litigation finance? So at the core of it, that's really what the Legalist technology platform is built around today. Even though we manage more than just litigation finance, what the technology does is it helps us to source investment opportunities and put them through an initial layer of screening so that we can proactively identify investments that we want to make.
Super interesting. So I'm sure there's more, but there's at least two parts to talk about. One is the investment process once you've gotten through your top of the funnel and you've identified things, and how does that work? But then the first part, just getting that information through, and you said scraping it from different federal sources. I'm really curious to understand how you did this in kind of the Y Combinator context, right? So in 2016, if you think about the market, there was a push into big data, and big data was absolutely a theme, but we hadn't yet had the machine learning and neural network revolution to the extent that we've had today. Can you talk about the early versions of that software? Like, how did you build it, and then how has that evolved?
Yeah, absolutely. Yeah. So investors ask us about this all the time. They want to know what the difference is between generative AI, like they're seeing today, and the AI that we used back in the day. And fundamentally, what AI is a loop whereby the machine improves itself. And back in the day, what we were using AI for was really to understand the data that we were looking at. So if you look at a court docket, for instance, the access to the data that we're using is not revolutionary. LexisNexis has this information. Westlaw has this information. There are plenty of legal analytics startups that also scrape state and federal trial court records and assemble that information. But classifying and knowing what you're looking for, that's really where a lot of the AI that we built back then was based around. So things that are pretty simple for determining whether you want to invest in a case or not, for instance, what type of case it is, or what the party types are actually surprisingly complicated if you want to do them with any great accuracy or efficiency. So, for instance, classifying whether the party that you're reaching out to is a business or an individual, and whether their defendant is a business or an individual. I'll give you an example of why we don't want cases where a business is suing an individual. It's usually not collectible. So if you have a business suing an individual, it might be a collections lawsuit, it might be a theft of trade secrets lawsuit, but the person on the other end usually doesn't have ability to pay. And that makes it really difficult for us to invest. And I can talk about this later in the underwriting process, but the three components that any litigation funding investor is looking for are liability, which means will the case be successful? Collectability, which means will you be able to collect from the other party? And damages, which means if you are successful and you're able to collect, how much would you actually make at the end of the day? And collectability is a really important and often forgotten portion of that. So a lot of the AI we built back then was just doing really simple things like that, and with the end goal of being to identify the cases that we want to invest in. Now, today, what generative AI is really good at is not just understanding that information, but generating text from the information that it has ingested. So that's a lot of what our team uses today to really craft custom outreach messages that incorporate the text of the government contract we're reading or the litigation document that we're assessing, and incorporate it into the messaging to make it seem more human-like. So that's kind of an example of how the technology has evolved from then until now. And I expect that with the advances that AI is making every day, that we'll have to continue to evolve to stay ahead of the curve.
For that early classification, what were the approaches that you used? Were you training like a neural net that you were running on some cluster, or were you using like a third-party cloud provider? How did you get to, and then how were you structuring the data to be able to train the model in the first place?
That question might be a little bit technical for me because my co-founder was the CTO at the time. I know that we were not using anything super complicated, like an unsupervised machine learning model or anything like that. Everything we did was supervised, and it was on very micro problems, like what I mentioned, this idea of assessing whether the defendant was a a company or an individual. What you can't do is you can't run a loop on case outcomes because case outcomes are secret most of the time. So all settlements are secret. So you can't run like a loop where it's like, is the case going to settle for a large amount? Because you actually have no idea how much it settles for. We tried doing it on cases that had a positive judgment, but unfortunately that information was so limited because so few cases go to trial that we were afraid that it would skew the outcomes in some significant way. So we ended up not using that information towards the later stages. What we did use is we did use things to determine whether they were predictive of surviving interim dispositive motion hurdles. So motion to dismiss or motion for summary judgment, as those are instances where cases can be kicked out of court. And there are a lot more of those because even cases that settle usually go through at least one of those.
That's super fascinating that the outcome is actually not known. I can imagine any sort of digital lender getting pretty frustrated with a data set that gives you like an enormous set of qualitative data and then doesn't tell you what actually happens.
And then the other thing that makes it a little bit more complicated as well, and this is what I imagine people miss when they think of litigation funding as a purely quantitative exercise. Even assuming that you knew the damages figures going into it, you don't know the damages figures for the cases that you're investing in. So let's say that someone comes to you, and let's say that you have a perfectly well-trained data set, and someone comes to you and says, I've got a case that's $10 million. Then you could say, oh, yes, let me match it up to my other cases that have $10 million trial outcomes or $10 million settlements. And then you put in a proportional amount of money, but then you find out the case is only a $1 million case. So that information, the damages information, is virtually impossible to get solid information on a going forward basis because every plaintiff will say my damages are X amount. Like the amount of $1 billion damages cases we've heard, we always joke internally, if they were all worth $1 billion, then the entire US GDP would be covered by the litigation that we've seen.
We talked about that initial part of getting the data and trying to organize it. What about that second part, which is trying to make decisions about which cases were worth investing in and which were not? And maybe this is also an opportunity to talk about what the asset class is like at all, and then how did you build the investment organization?
So you can think of our tech as being extremely helpful for initial screening and initial sourcing. So there are 80 plus million civil court cases filed every year, and we pick a few 100,000 to reach out to. And from there, about a couple thousand of them respond, yes, I'm interested in litigation funding. But even from there, you still need underwriters or human lawyers, really, to take a look at each case and determine what amount would be appropriate to invest, how to stage the investment, and other just granular details like that. You still need someone to negotiate the credit agreement. And so our team, led by a really fantastic portfolio manager, has 3 underwriters who are all lawyers. And their job is to, day in and day out, look at these investment opportunities and make some determination at investment committee about whether we should invest in them, and then also how much we should invest in them and how we should price them. So from there, it looks a lot more like a traditional litigation finance investment process. The only difference is that they're dealing with unprecedented volume on the front end and have a lot more cases to pick from.
How do they navigate that? I mean, it must be a pretty different environment. And if you think about the various fintech themes that have happened over the last decade, like there's a lot of discussion, and I think this is probably true for what's happening in artificial intelligence now. There's a lot of discussion about kind of hybrid productivity where you have a human being performing their craft, like work that is difficult to learn, that has taken them a long time, at which they have expertise, and that is very manual. But then combining that in a hybrid work environment with machine labor, whether it's route automation, just getting data through, or whether it's using machine learning models to sort of pre-make the underwriting decision. I think we see a lot of this hybrid setup as the answer to, will AI take away everybody's job or will they make them more productive? What's it like for people in your firm? How does it look?
I think from the perspective of the underwriters themselves, the cases that come to them are just pre-screened in ways where normally they'd be looking at a bag of apples and oranges and pears, anything that's brought to them by brokers and bankers. Whereas with the technology, and our LPs have commented on this as well, we're able to achieve remarkable consistency with what we source, and that makes the underwriters' jobs a lot easier, so they can use the same method and print a lot more of similar investments. So that's really how they interact with the machine. Unfortunately, the process of underwriting a litigation, I don't actually think will ever be able to be fully automated, at least not the complicated commercial litigations. To give you an example of like a prototypical case, we see our most common case types are breach of contract and business torts. So we'll just take a breach of contract case as a prototypical one. So let's say that the fintech Blueprint gets acquired for a $10 million buyout. And
now we're talking.
Yeah. And so you have some sort of earn-out agreement. And the earn-out agreement says, if you stay for 1 year, you make $2 million. If you stay for 2 years, you make $5 million. And then if you stay for 3 years, you make all 10. And then there are all these hurdles in the middle where, you have to hit certain revenue milestones. And after the acquisition, the acquiring company finds all these ways for you to not hit your milestones or makes the situation so untenable that you're not able to stay. So that's really a more subjective measure, right? And that's very typical of the cases that we see where they're not completely black and white. You could see it one way or you could see it the other way. And at the end of the day, it's going to come down to human judgment as to whether it is level 2 or level 3, although it's undisputable that you're entitled to something. And so a lot of what our underwriters do and what the jury does at the end of the day is say how much, we know that the fintech Blueprint is entitled to something, but how much are they entitled to? And we size our investment proportional to that. If we size it too large, then you have a moral hazard problem where in order to exit the litigation, in order to settle the litigation, the hurdle is too high. It's very comparable actually to startups that raise too much money. The liquidation preference is too high, and so they can't take a very reasonable exit. But then if you invest too little, it's very difficult to get the law firm to agree to litigate a case for what they view as below the amount they would make if they were just billing hourly or with another client. These negotiations, I don't think will ever be able to be fully automated, not to mention the underwriting process for determining the damages themselves.
I'm on an emotional roller coaster about my failed acquisition already. So between 2019 and now, the firm's assets really grew very, very aggressively from 100 million to 900, as you say. Did that overlap with your adding these other strategies, or what happened to create the turning point for you?
So we raised our first fund, which was only 10 million of assets in 2017. And that was the hardest 10 million to raise in my life because we had no track record and no investment experience and nothing except for this technology that we had developed at Y Combinator. So those first couple years of raising the 10 million, investing the 10 million were extremely difficult. And in 2019, when we closed our first institutional fund with insurance companies, endowments, foundations, and a lot of our advisors who came in early, that really put us on good footing to start building our track record in earnest. And that first fund ended up doing extremely well, which led us to be able to double down on that with a much larger litigation fund, as well as to raise these other strategies, most of which use the same technology. So our bankruptcy fund, which we launched in 2021, that one focuses on sourcing small dollar bankruptcies with significant assets right as they file. So before the creditors have had a chance to foreclose, right as they're looking for what's known as a DIP loan or a bridge loan for them to liquidate during the bankruptcy process. Our tech is really good at identifying those opportunities that are off the beaten track and swooping in to offer them a DIP loan right as they file. And then our government receivables lending strategy That one identifies federal and state contractors who are at a turning point in their business where they really need a credit facility for working capital. So those are two strategies that we've really built out since 2019, and they contribute around 400 of the AUM that we've raised. But another 400 just comes from our litigation finance strategy continuing to do well and to grow.
How did you figure out that these were the following strategies? Was it that, you had built a team that could intelligently pull apart where the value was, or did you do like a big analysis of the space? How did it make sense to you to expand here?
Yeah, so LPs frequently don't understand exactly what our technology does. And so they will just throw ideas at us for things that we could scrape, which have no data source, or things that we could invest in, which have no data source. And so I think the most important thing for us and for our technology is having a comprehensive, usually government-run data source by which we can proactively identify investment opportunities in a space where other people would love to invest in these if they had access to the kind of deal flow that we have. So I'll give you an example. In government receivables, the government is clearly the best counterparty for any kind of receivable, right? So why do people invest in commercial receivables at all? The answer is usually because they can't source enough government receivables. Well, what if you could identify companies that have government contracts and are in need of receivables financing at their particular stage, and then you could only source government receivables? Wouldn't that be better than just a standard receivables lending fund? That's kind of the approach that we take, but of course there are three components to it. One is the data available? Two is, are the returns juicy enough? And then third is there LP demand at this juncture for a product like this? So we triangulate between the three of them, and then eventually we settle on what we're going to do next.
Let's talk a little bit about your LPs and the fundraising process. A lot of endowments and institutions, when they're investing, they have a point of view from an asset allocation. And maybe there's a venture portfolio and a private equity portfolio and some hedge funds. What you've described is a pretty novel strategy, as well as a modern approach to executing on that strategy. I expect you'd had to educate a lot of the allocators that you talked to. What was that process like? And how do you position the firm with institutional investors, and what kinds of institutional investors are the most appropriate?
That's a great question. Sounds like you're running a fund yourself. The types of allocators that litigation finance appeals most to are folks who are very worried about the financial markets and are looking for an uncorrelated source of return. So all of our strategies fit into this general area that's called diversifiers, or sometimes called uncorrelated, sometimes called absolute return. So these are things that are not related to how the markets are doing. Zero beta strategies. Sometimes we get grouped into like long short equity funds because we're similarly kind of a hedge fund structure, a hedge fund like investment profile, but our returns are much greater than the standard hedge fund. So how LPs bucket us really depends on how they're internally organized. Now, I will say the type of group that is a lot less interested are generally investors who are less sophisticated. So if they're just getting into alternatives to begin with, if they're just trying to fill out their venture allocation, their private equity allocation, then they're probably not going to get to more esoteric strategies like us for quite some time. So if we're talking to them and they're like, yeah, we've got some stocks and some bonds and we're looking to add some private equity, we're like, oof, you're way too early in your journey for us.
When you think about the scale of the strategy, how big do you think it can get before losing the ability to generate alpha? And similarly, what keeps you up at night in terms of competition or having other firms come in and try to eat away at the return you've been able to generate?
We're really big on market comps. And so I think market comps are a pretty good reference point for how big each of our strategies can get. And the answer is not very large. So the largest litigation funders, the largest government credit funders, they're each only a couple billion of AUM. So I would be very surprised if each one of our strategies could scale to more than $1 billion or a couple billion of AUM, because then they would literally be the largest player in each of their fields. Now, that said, our technology is really the cornerstone of what makes each one of our strategies work. And so, unlike a lot of GPs who have no desire other than to grow their strategy until there's no alpha left, we would much rather keep each one of our strategies small, generating tons of alpha, and then see what our technology can do next, what sorts of new and emerging opportunities there are out there. So the way that I like to look at it is that, oftentimes when you've been around the block a little bit, you look around and you're like, there are no opportunities left. If only I had been, around during the 2000s when Facebook was invented. If only I had been around, when Airbnb was invented. If only I'd been around when, private equity was first emerging as an asset class. But that's looking backwards. If you look forwards, every single year, there's a fresh crop of 20-year-olds who are going into the workforce with wide eyes, and they're looking around and they're saying, oh my gosh, everyone's doing things so stupidly. There's so much opportunity. And the only reason that we stop being able to be those 20-year-olds is because we get jaded. We get overly angered to what we've seen in the past. And so in my mind, as long as our technology keeps on evolving, as long as we keep on generating alpha for our investors, there will always be new opportunities to deploy funds, even if for whatever reason, in 50 years, litigation finance is no longer a hot new asset class. So I'm not too worried about that, but I hear where you're coming from.
How do you think about the intersection of the legal system and the financial system more generally? Like, are there any moral hazards that you see in terms of sort of these incentive structures that different law firms have in pursuing adversarial litigation? What you've built is fascinating as like a construction of technology, law, and investing. But do you ever think about, from a more macro perspective, like, are there any learnings that you have about that intersection of economic incentives and legal actions in the US?
It certainly made me a lot more jaded about litigation and about lawyers in general. So here are the reasons why we invest primarily in smaller cases. So compared to most litigation funders, our average case size is only about $1 million investment. And most litigation funders have a minimum of $5 million and up. The reason that we target cases that are smaller is precisely because of the economic incentives of the lawyers involved. So off the record, one of the lawyers that we had talked to once, who was a defense attorney, told us that defense lawyers always know how much a case is going to settle for. They do a bit of back of the envelope math, and they say, okay, if the case is going to settle for $10 million, I can only bill up to 20 or 30% of how much the case is worth. Otherwise, the client is going to be mad at me. They're going to look at their bill and they're going to say, wait a second, you spent $10 million to defend me in this $10 million settlement. Are you serious? And so defense lawyers always have to keep their spending in check. Now, what that means is that if the case is very large, if the damages in the eventual settlement are going to be enormous, then the defense lawyers have an incentive to keep billing for as long as possible. And they have virtually unlimited budget with which to do so. So when you're a litigation funder and you're coming into the industry and you're saying, I really want to invest in that extremely large case that's going to be really lucrative, well, then you should get ready for a case duration of like 10 plus years. It's going to be ages because everyone involved has incentive to just keep billing and keep billing and keep billing. So all of that has made me somewhat jaded about lawyers. The way they say it depends, the way they say, I don't know how much it's going to cost. It really depends on what the other side does. The way they say, well, I don't really know how much this case is going to settle for. We'll just have to keep billing and see. It's made me very jaded about the entire legal business model. And it's also made me very jaded about being a plaintiff. Being a plaintiff is an extremely unfun thing to do. And if you're a plaintiff, you are getting emotionally involved in the thing that caused you the greatest distress. And you have to be reminded of it every day for like sometimes 3-4 years. And so by the end of it, it's as if you woke up every day and went to work to think about the most unpleasant thing that's ever happened to you, or the biggest fight you've ever gotten in with someone who's close to you. And you have to think about that every single day. I think it really changes the mood of a person on a micro level, but on a macro level, I think it has some detrimental effect on their life quality. And for that reason, I would be very, very cautious before being embroiled in litigation as a plaintiff personally. They just don't know what the toll it's going to have on them personally is when they start.
That's a very thoughtful answer to a complicated topic. And one thing I remember well from law school is the description of anything that goes to a court is an exception. It's a conflict. The things that are normal and in the middle and, happen all the time where you can reach a negotiated outcome, that's not going to hit the legal system really. But the things that get court opinions and then become black letter law, those are the things that have been problems. And so it is very stressful to live in the problem zone because you're literally outside the bounds is pretty profound.
Right.
One thing I wanted to ask you before we wrap up was, your view on other asset classes and other parts of the alternative investment ecosystem where maybe you see potential for technology to kind of transform what it's doing. There's lots of investing that's very kind of crafts based. Venture investing, a lot of credit investing is just sort of human intuition and arcane paperwork into some sort of alchemy. Where do you think we could see similar transformations to what you've done in litigation finance, or what other asset classes are capturing your interest?
I think we're set on new asset classes for the time being, but generally speaking, I think that you have seen a wave of interest in alternatives from retail investors over the past few years. Originally, it was just RIAs and wealth advisors who are getting into the space and investing in more off the beaten path products. But over the last few years, although I'm not totally sure whether this is just a bull market phenomenon, you had retail investors, some of whom weren't even accredited, investing individually in startups and cryptocurrencies, in art, in wine. Time will tell whether these things actually pan out, but I think the general world of alternatives has suddenly become interesting, even if it's just as a fun personal hobby more than it is an investment product for the retail audience. So that's a phenomenon in alternatives that I've noticed, although I'm not sure what the longevity of it is going to be.
It's really tough, especially with retail investing, to have the patience to be interested in this stuff. Like you said, that even allocators that are following a structured approach might not know what litigation finance is. They're still picking their private equity provider. And at the same time, in the retail space, we have people who are, like you said, using Masterworks to lease or buy art, or investing in NFTs or crypto, or writing angel checks through equity crowdfunding. Is there an inherent danger of that kind of exposure?
There is absolutely an inherent danger. What I've noticed more frequently in my space is that when I hear about an individual, even if it's a relatively sophisticated individual who says that they've invested in one litigation, they say it casually, almost like they're bragging at the country club. They're like, oh yeah, I've invested in a litigation. I'm like, you have? That is not a good thing. You realize that these have binary risk, and you as a non-lawyer are almost terribly ill-equipped to underwrite the litigation. I wouldn't be so happy to brag that you've invested in a single litigation. Not to mention, if they have invested in a single litigation or a single startup or a single XYZ from a platform that is using either some sort of tokenization or equity crowdfunding, the reason that those platforms are so risky is precisely because the SEC has all these rules in place to protect consumers for a reason. And the reason that everything is so regulated, the reason that everything is so difficult to access for retail investors is because they don't know how to fit it into their portfolio in a reasonable way. So the entire space makes me a little bit nervous. as someone who has firsthand knowledge of how difficult it is to invest in one litigation.
Absolutely. Well, Eva, thank you so much for coming on the podcast and sharing your story. If our audience wants to learn more about you or about Legalist, where should they go?
Our website is legalist.com, and we have all our information there.
Fantastic. Thanks again for coming on.
Thank you so much, Lex.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things FinTech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.